This week I wanted to talk about real estate, and particularly real estate in Southern Ontario. I think it's one of the most frequently asked questions that we get, and particularly in the last 6 months, is that can the real estate problems that you're seeing in the U.S. actually happen in Ontario? And I want to talk about that in two different ways. One is I'd like to talk about the long-term drivers that have been driving real estate prices, and then also talk about real estate in your overall portfolio. Real estate has been driven to a large extent by three big factors. One has been the baby boomers. As the baby boomers sort of left the nest and started buying homes, it created a demand in the real estate market. And that demand, there wasn't enough supply for that, and you had prices going up throughout the 1980s and 1990s as baby boomers started their households. But we've gotten to a point now where the average home now is held by somebody that's over 60 years old. So that as these people start to retire or become empty nesters, it becomes a source of supply. So that demographic push is pretty well finished in terms of the real estate market. The second driver of the real estate market has been interest rates. We've been in an environment where interest rates really since the early 1980s have continued to decline. In the early 1980s, certainly if you talk to your parents or your grandparents about their mortgages, they were funding their home purchases with 16 and 17% mortgages. We've gotten to a point now where people are funding mortgages with 4% interest rates. So we're to the end of the push that you're going to get from lower interest rates. So you're not going to get much more of a push from interest rate movements. The third factor has been leverage. And by leverage, I refer to how much money you have to put down to actually buy a real estate. Starting in 1900, it was illegal for banks to lend, so all real estate transactions were 100% cash. Then they would only lend to 10% of the value of the home. So you could put 90% down and borrow 10. And at the time, that was viewed as being very aggressive and very risky. And as you roll the clock forward throughout the 1970s, you put down 30% to buy a home and you borrow 70%. And if you look at it today, now you can get real estate at 0% down. You can basically finance 100% of the purchase. So unless people are going to loan you 150% of the value of the home, the push that you're getting from the additional degrees of leverage that you can get has come to an end. So what does that mean for an individual investor? First of all, I wouldn't have all my investments sitting in Southern Ontario real estate, because if that goes down, it's going to have a ripple effect across many different industries. Because so much of the economy is driven by real estate. You think about real estate agents, construction workers, people working in the banks, in retail. So all of those will come back to haunt you. So that from a portfolio perspective, it's best to have investments that are not tied to that. So invest internationally. So for individual investors, they should look at their investment portfolio and make sure that they aren't overly concentrated in investments in their own backyard.